In this video, I am going to show you how to trade using trend lines together with price action. As always, make sure to turn on the notification bell so you'll never miss a setup breakdown like this one. So what is a trend line? A trend line is a trading tool that is used to find entry and exit points in trending markets. Basically, trend lines are lines you draw on your chart. These lines tells you which direction the market is going next. Knowing this, you're able to find entry points to capitalize off the market movement. Before we go on with applying trend lines, here are key points to know when using trend lines. 1. You need a minimum of 2 points to draw a valid trend line. 2. When you draw the trend line, you must only use the endpoints, meaning your line shouldn't cut right through price unless with the exception on our third point, which is if you drew your line correctly and price breaks the line, it means a trend or direction of the market is changing. So just like at a key levels, when price revisit a trend line, expect one of two things. The first one being price reaches a trend line, then reverses. This indicates a possible trend continuation, meaning as long as price stays above the line, you'll be looking to find and hold trades going up. The second move at a trend line is price reaches a line, then proceed to break and close below. This indicates the start of a trend change, meaning as long as price doesn't retrace back to the trend line, immediately the break is valid. So you will start looking to find and hold trades going down. So in essence, using trend lines helps identify the trend, and when price revisits, they present trade opportunities. Now let's combine this together and apply it on the charts. In an uptrend, you draw your line going up. When price returns to the line, you look for reversal patterns. And if they align like this rejection, which indicates that buyers are holding strong at the level, you can take your entry long at the bullish engulfing candle, as this close indicates new buyers have entered at the trend line, and this newly added momentum is what pushes price higher. In a downtrend, you'll look to go short. These two touch points give you a trend line. Price returns and form a long wick candle rejecting the trend line, indicating a possible end of the pullback. This close down confirms the end of the pullback and indicates that we now have more sellers than buyers in the market. So price will go down and respond to the gain of bearish momentum. So at this close, you take your entry short and price goes down in your favor. These two touch points give us trend line. Price comes back and forms a long wick candle, rejecting the trend line. Entry 1 at the close of the bullish candle. This two touch points give us a downward trend line. This break above reconfirms the bullish sentiment, giving us entry 2. This high right here give us our first take profit point. So when price reaches the area, you'll be looking for a reversal pattern to let you if price is reversing or you should keep holding. When price reached the level of bullish engulfing candle formed, closing above. So we continue holding. These two reversals give us a trend line, and price sold heavy after the third touch point. This indicates that the trend line is valid, so we can use it as a take profit point. Evidently, when price reached the line, a long wick candle formed followed by a bearish engulfing candle, indicating the gain of bearish momentum. So we close our entries. This low and the pullback give us a trend line. So when price revisit the line, you'll be looking to go long after the trend line rejection. But in this case, a bearish engulfing candle formed instead, so no trade long. This break confirms the bearish presence indicated by this bearish close. And after the break, price didn't return immediately, validating the trend change into a downtrend. So at this point, you start looking for trades going down. This high together with this lower high give us a trend line. These two reversal points give us a key resistance level. This point then presents first entry point to the bearish move. On the pullback, we got the long wick candle rejecting resistance. The rejection indicates bearish presence at the trend line, meaning price might reverse, starting a trend continuation. But we need confirmation that enough sellers have entered to overcome this bullish momentum. So at the close of the bearish momentum candle, you take your entry short or use the trend line break on the lower time frames. Notice how this key level provided an exact point to watch for the trade on the trend line rejection. This means that trend lines can be used together with key levels to find more precise trade entry points. This is the Bitcoin chart on the 2-hour time frame. We initially identified an upward trend defined by two higher swing lows, forming a valid trend line. As price pulled back toward this trend line, an inside bar formed, indicating temporary consolidation. However, no bullish momentum candle followed to confirm renewed buying interest. Instead, price closed below the trend line, a potential early signal of trend weakness. This was later confirmed by the formation of a lower high, suggesting a structural shift from an uptrend to a downtrend. By connecting the previous high and this new lower high, we established a descending trend line. Rather than trading immediately off the trend line, we look for a confluence with a key level, improving precision of the setup. Following the trend line break, price pulled back to a previously tested support-turn-resistance area, where long upper wicks indicated rejection. A strong bearish engulfing candle formed at this confluence of resistance and a descending trend line, signaling the presence of aggressive sellers. This confirmation provided a potential short entry opportunity, aligned with the emerging downtrend. This method can also work the other way around, meaning instead of using key levels to find precise trendline entry points, you can use trend lines to validate key level trades. These reversal points give us a key level. After this break, price retested before forming a bullish engulfing candle off the level. So you take your entry long. Immediately after that, price formed candles that indicated price might be reversing. Using the key level alone, you would probably close this trade suspecting a false breakout. But if you include the trend line, you would know that price is in a fresh trend change with heavy bullish momentum, considering it was able to cross above the long-term downward trend line. This then becomes a possible retest of the lower time frame's minor key levels, so you continue to hold. This is just one of many tools you can use to gain an edge in the market, but we can't cover them all in one video. So make sure to subscribe and turn on the notification bell so you never miss an upload.